Now, there's a lot of fear in the market. So, what type of ETFs are best to buy for this type of environment? If we take a look at the fear and greed index, we can see we're having a period of extreme fear. And we can see down in the past 5 days, the market is trending downwards. The NASDAQ 100 QQQ is down 3%. In the past month, it is flat. So, we are at pretty much close to the highs of the market, but a lot of people are pretty skeptical because the economy is not doing well. How are these companies doing so well when a lot of people are suffering? The job market is terrible. Grocery prices, inflation has been killing a lot of people. So that is the main reason why a lot of people are very concerned with the market. And a lot of people are holding ETFs such as ULTY, and it's down 17%. And that is mainly because we can take a look at the holdings. These are a lot of speculative companies. A lot of people just don't understand that if these underlyings are going to drop in share price, the ETF is going to as well. And that is also the case with WPay, another popular weekly paying ETF. It has a ton of tech-focused companies, and we've seen a massive drawback in the market, especially the tech sector. And if we take a look at the past week, it is down 7%. So a lot of people are calling this NAV erosion, and it did have a pretty painful drop all the way from $54 per share down to the lows of $48 per share. But we have to understand how this ETF works, which is actually going to use 1.2 times leverage. So it is going to drop more than the underlying companies it's holding. And overall, these are very risky ETFs. WPay, ULTY, a lot of these cover call ETFs, they're choosing underlyings that have a lot of volatility because you're going to get a higher premium for that weekly or monthly income in the form of dividends. Now, what type of ETFs should you buy in order to survive this type of environment? Well, if you can't really stomach this volatility, you may want to switch to some of the safer ETFs. Now, what do we mean in terms of safer? Something that doesn't drop, something that's a little bit safe, and especially since interest rates are predicted to drop, you are not going to make as much money from, say, ETFs such as SGov, which is going to be dropping its dividend yield if the interest rates drop even further. A lot of high yield savings accounts have dropped about 0.5% basis points. So one of the ETFs that comes to mind is going to be SCHD, and a lot of people hate this ETF. We take a look at the past year, it's down 8%, and we take a look at the past 5 years, we can see it's up 38%, but the past 4 years, 2021 to now, has pretty much remained the same share price. And that is the main reason a lot of people have switched from SCHD to a lot of these covered call option focused income ETFs. They want more income, they want it more often, and they also want something that increases in share price. Now, if we do scroll out on this ETF, we can see it does have some pretty stable, nice, steady gains in the share price. And for people who can't really stomach volatility, this is a good choice. Remember, the riskier an ETF or stock is, the more potential reward, but you can also lose a lot more money. And if you are a long-term focused investor, that is something you have to consider. But SCHD has been a very good ETF. I'm still holding a little bit of shares in my portfolio, but the main reason is it's going to have a 0.06% expense ratio. Now, comparing that to something like ULTY or WPay or YMAX, a lot of those ETFs are going to have a 1% expense ratio, which can contribute to its decline in share price because you do have to factor in that it is going to decline at least 1% every single year. Now, for SCHD, the fund's goal is to track as closely as possible the total return of the Dow Jones US Dividend 100 Index. You're going to have potential tax efficiency. Some of the distributions are going to be taxed as long-term gains, so that's something to consider. And it's going to be diversified. You know, you're getting high quality stocks, and it's going to rebalance every single year to make sure it's a high quality ETF. And the downside to this ETF, you're only going to be getting about a 4% dividend yield annually, and it only pays out quarterly. But that is not really the purpose of this ETF. This ETF is a dividend grower. We can see the growth of the dividends has been increasing. So if you buy early, you get in pretty early, you are going to see your dividends grow over time, which is not something you're going to see with some of these income-focused ETFs, which are going to go up, they're going to go down. With this ETF, it's a dividend growth ETF, meaning your dividends are going to continuously grow over time. And that is something that a lot of people are not taking into account. But in my opinion, this is a very safe ETF, holds a lot of defensive companies. We can see a lot of essentials. We have Coca-Cola, we have Chevron, PepsiCo, Verizon, Home Depot. These are companies that produce products that are going to be around for a long time, and they're pretty much recession proof. People are still going to need gas. They're going to need Coca-Cola. People are going to need packages delivered with UPS. And that is the reason why a lot of people should probably consider this ETF if you don't have a very high risk tolerance. And especially if you're kind of scared of how the market is, the economy is not doing great, maybe you should consider that. And then the next ETF is actually going to be iShares 20-year Treasury Bond ETF, TLT. And this is going to be a good ETF if you do believe the interest rates are going to fall. Because if the interest rates fall by a considerable amount, you're going to see a good increase in the share price of this ETF, because the dividend yield is going to remain around the 4% yield, meaning a lot of people are going to favor this ETF over SGov because of that higher yield. But right now it's at a pretty low point. If you do anticipate the rates are going to fall, maybe you should consider TLT. It has a 0.15% expense ratio. You're getting exposure to those long-term US Treasury bonds. So you're going to be locking in those 20 plus year Treasury bonds. It's not really going to react immediately in terms of the dividend yield to the interest rate changes, which is why it would increase in price. It's more valuable. And the best thing about a Treasury bond ETF, it's a lot simpler just buying and selling an ETF simply on the stock exchange versus compared going to the government website and buying those treasuries. It's a little bit more complex and you do have to manage it. Whereas this, it's very simple just for the small fee of 0.15% expense ratio. Now, if you're looking for something that is going to produce a higher yield, and we do want to note it does pay out a 4% dividend paid out every single month, which is pretty sweet. If you want something that pays a little bit higher, maybe consider SPYI or QQQI by Neos ETFs. These have been pretty popular. We can see it's only down 1.21% in the share price, and it has that dividend yield a lot of people are looking for, 11 to 12% paid out every single month. So we can see the dividend history. It's been pretty consistent, hovering around 50 cents per share every single month. So for people who are looking for something to supplement their income, they want that dividend income, they want something higher than SCHD or TLT, this could be a good choice. But just know you're getting exposure to the S&P 500, so you may have some drawbacks. But overall, it's been pretty consistent. It's been pretty stable. I've been pretty happy with this ETF. Now, if you want to go a little further, you have a higher risk tolerance, but not as high as something like WPay by Roundhill. You could consider QQQI, which is going to have a higher dividend yield because it's going to be on the NASDAQ 100, which is a more volatile focused index. And you're going to get a 13 to 14% dividend yield annually paid out every single month. And we can take a look at the chart. It's down 2.56%. So it is going to be a bit safer than QQQ because if we see it's actually down more in share price compared to QI, which is very nice to see. So if you do want to choose this ETF, it will not drop as much as QQQ will. And we do want to note that this ETF, of course, many of you know, has one the 2025 award for Best New Actively Managed ETF. It's had great performance, has a great track record. In my opinion, a lot of people have transitioned from some of the riskier yield max ETFs to the NEOS ETFs. They realize that yield max is kind of not giving them the returns they're expecting, because even though some of those yield max ETFs have yields of 80%, 100%, you're going to have that NAV decline. You're not going to have any upside appreciation in the share price. And that is what QQQI is going to offer to a lot of investors. Even though it has a smaller distribution rate, you are going to be a little bit more stable, something you can actually sleep at night. And you know the fund managers behind NEOS ETFs, which have some pretty high quality products, are going to do their job correctly. And the best thing about this ETF is it's going to be more tax efficient. They're going to utilize something known as the Section 1256 contracts, which is going to be subject to lower 60-40 tax rates. So 60% is going to be taxed as long-term capital gains. It's going to reduce your tax bill, and only 40% of that is going to be the short-term capital gains, which is going to be a little bit higher of a tax rate. But you can check out all the information about this fund on NEOS's website. They have a lot of great products. They also have some hedged equity income ETFs where they actually buy protective puts, but those are going to eat into your premium because you do have to buy those put options, which can be costly during some times. So if we take a look at QQQH, we can see it's actually going to have a 9% distribution rate, but you're going to have a little bit more stable of a share price if that's something that you're after. And they also have a lot of high income alternatives. They have one on BTCI. I'm a huge fan of that ETF. They have one on real estate, IYRI, and they also have one on gold, IAUI, as well as some enhanced fixed income, one on bonds. They also have one on TLT, the Treasury Bond ETF. So there's a lot of options on NEOS ETFs. They're not really a huge fan of the single stock ticker ETFs that we've seen YieldMax release at least 50 of them. In my opinion, those are way too risky. You want something that's a little bit more diversified or tracks an index like gold, Bitcoin. These are going to be a little bit more safer in my opinion, and we can see that with the share price of these ETFs. They're more stable and they also have some capital appreciation. We've seen that during Liberation Day, April timeframe, when it dropped all the way to $42 per share, and then it did recover to $54 per share. Even though it is selling covered calls, they are leaving some room for upside growth. So let me know down below what your thoughts are on the market. Are you holding any of these ETFs, SCHD, TLT, QQQI, SPYI? There's a lot of great options out there that are safer for this type of environment where we're in extreme fear. So that is something to consider. Make sure you understand that a high distribution rate, the higher it is, like 80%, 90%, 100%, that is going to be more risky, and you do have to understand that you are taking on a risk for obtaining that highly insane distribution rate.